Good morning, everyone. Thank you for joining us. My name is Kara Heifel. I'm with the Illinois Restaurant Association, and I'd like to thank you for joining us today for the webinar on employee retention tax credits and other tax savings. We'll have a lot of information coming ahead, and we'll hope it'll be useful for you. Also, during today's webinar presenting, we have representatives from Manning, Silver and Company and Paycor. This webinar is being broadcast in English, Spanish, and Mandarin Chinese. Please use the interpretation button in your toolbar if you would like those interpretation services. And as a follow-up to this webinar, you'll receive all the information, and each party, Manning, Silverman and Company and Paycor, also offer services in a host of different languages. So this webinar is also being presented with us at the Illinois Restaurant Association in conjunction with the Cook County Small Business Source. And this Cook County Small Business Source was established to ensure that businesses emerge fully from COVID-19 and positioned for growth for the future. The Small Business Source connects small business owners with expert guidance and support. Some of those services are no-cost business advising, other resources, events like roundtables and grow grants, and a number of advisors we can connect you with for one-on-one support. There's a huge network, including us at the Illinois Restaurant Association with the Cook County Small Business Source, that can provide advising and other small business resources throughout anything you need. All of our contact information from the Restaurant Association and our panelists today will be sent over to the participants after. You'll receive it in an email, and then it also will be on our website. So make sure you also check out our website at illinoisrestaurants.org and sign up for our newsletters if you haven't already. Also, before we begin, I'd like to remind everyone that myself here at the Illinois Restaurant Association and all of our staff are focused on helping all small businesses, especially the hospitality industry. And we are constantly working day in and day out to provide guidance, assistance, relief, technical support, and anything you may need to help your business emerge slowly and grow for the future. So now for today's webinar, you can use the Q&A button in your toolbar to post questions at any time during the presentation. Or if you see another person ask a question that you like or would also like answered, go ahead and hit that thumbs up button so we can make sure to prioritize if needed. And we'll try to get to all the questions today at the end, but if we don't, we have all the contact information we'll send over to you for any follow-up questions. So without further ado, at this time, I'd like to introduce our panelists. With us today, we have Joel Manning. He's the managing partner and principal and founding shareholder at Manning, Silverman and Company. Chloe Carter, and she's the principal sales consultant at Paycor. And we have Brett Byoffice, who is the field marketing manager for Paycor. We're going to first start with Joel Manning. So Joel, please take it away.
Thank you so much, Kara, and welcome everybody. Thank you for spending time with us today. And I hope you'll learn a lot about the ERC, retention tax credits, that should provide money for each of you. And so when we get into it, we'll start to see some opportunities that I think will affect each of you so that you can receive your share of the refund. A little bit just about myself. Our firm, Manning, Silverman and Company, we're a full service CPA firm. We started over 35 years ago. We have 6 locations here around the Chicagoland area. Let's start to talk a little bit about ERC. So in our first slide, you'll start to see, it's very simple. Everybody has a right to earn up to $26,000 for each W-2 employee. It excludes owners and their families if they own more than 50% of the company, and it's reduced by the PPP forgiveness for employees' salaries. So we'll talk about this in our next slide as we talk about how do you qualify. There's 3 ways to qualify. First, there was actually a business shutdown issued by the government, and it could be issued by the federal, the state, local municipalities, and counties, or there's a decline in gross receipts in 2020, 2021, and there is a third possibility that many people don't talk about, and that's for a new business that started up for ERC. So as we look into the next slide, we're going to talk about each of these issues and how you can qualify, because that's the most important thing. So let's first talk about a full shutdown. So a full shutdown is the government gave an order that said you needed to shut down. And here in the city of Chicago, for example, one of the most aggressives, we had our mayor who said, you must shut down. Well, during periods of actual shutdown, anybody who faced that shutdown qualifies. Also, if a business was essential and everything else was closed, it may not qualify under shutdown. But remember, anytime you don't qualify under one area of the employee retention credit, you can qualify under the other. So in November of 2021, the government changed the rules on all of us when it came to ERC. So many people keep looking at the original laws. The original laws said that shutdown was issued by the government and it was a complete shutdown. But in November 2021, the government came out with something called the partial shutdown. And we're going to talk a lot more about partial shutdown because the partial shutdown is how almost every restaurant, and I will say for me, our firm has done thousands of ERCs for clients and restaurants. We have not had one restaurant not qualify, not one. So let's talk a little bit about in our next slide, what a partial shutdown is. So in a partial shutdown, we see the example above about a restaurant that has capacity restrictions. If we remember, and some of us may still be facing it, but if we remember, you'd go into a restaurant and if I could dine in, there would be me and then there'd be nobody at the tables near me, or there'd be some glass in between tables. That was a restriction. And if that restriction is greater than 10%, you would qualify. Also, many of us have more than one restaurant. So let's say in the same entity, I was shut down in the city of Chicago, but I was not shut down in any other areas. I still would qualify as long as, again, 10% of my business was affected. So what I want to share with you when it comes to partial shutdown, which is how many of you get affected. And again, there are thousands of ways for you to get affected. We have all of those in our system, and I'm happy to walk through each one for each one of you to see how you can qualify. But let's say the majority of it was you had dine-in, you had delivery, and you had curbside pickup. Dine-in was canceled, but delivery, now hear this again, delivery, curbside pickup was not, and your business grew. It doesn't matter. If dine-in was restricted, you qualify. So the part that most people aren't hearing is your business can actually go up in revenue. It could have no shutdown, but it could have some restrictions, and you qualify to receive the $26,000 of employee retention credit. And in our next slide, just briefly, what I want to share is what we have done here at Manning Silverman for every state. We broke up every state into little districts. So if you look at this slide, what you'll see is districts 1 through 11, and in district 1 through 11, will show what shutdowns occurred, what periods of time shutdown occurred. We have that set up for you. So all we need to hear is what your address is. We can look in, we can immediately see what the shutdown was, and then we can determine did you qualify under shutdown. If we receive your revenue by quarter, we can see if you qualify under the revenue test. So here we are, that's the revenue test, and here the complete shutdown. But remember, as I said, and the next slide we'll continue talking, but what we have is that partial shutdown that we're going to talk mostly about for each of you to make sure you qualify to receive the most money you can. So in the gross receipts test, it works just like this. In 2019, that is our year that we use to see how much revenue you earned by quarter. So each quarter stands on its own. If your revenue was down by 50% from 2019 to 2020, you qualify under the revenue test. In 2021, it changes. The government realized we're really getting seriously in trouble for a very deep recession. A lot of you are hearing about recession talks. Without this money for each of you, we're talking about a very serious recession. Right now, the large companies are the ones getting hit. You're starting to see unemployment starting to occur from them. But what's keeping us going right now are each of you. And it's because you receive this money, hopefully you keep all your people employed and hopefully you add to that. So in 2021, instead of your revenue being down, we compare it to 2019 and see if it only went down by 20%. So if it went down by 50% from 19 to 20 in any quarter, or 21, it went down by 20%, you qualify under the gross receipts test. So again, so far we've talked about shutdown. Now we're talking about the gross receipts test. And if we go into our next slide, what we'll talk about is in that gross receipts test, if you qualify for 1 quarter, you qualify automatically for the next quarter. So it's a very important thing that once you qualify for 1 quarter, you qualify for the next. And in our next slide, what we'll talk about is what is a gross receipt? A gross receipt is really defined by how you file your tax return. And in the United States, there are just 2 ways to file tax returns. You either file under the cash receipts or you file under the accrual method. Most restaurants of, I'll say 5 million and less, will always file under the cash basis. So that means when you receive $1 and you spend $1, that's what we're looking at when we look at our gross receipts. Whenever you are receiving $1, it goes into that quarter. If you're on an accrual basis, we learn to match revenue with expenses, and we can talk to you about that if you're not very familiar with it. So if we go into the next slide, what we're going to see again is if an employer would qualify for a quarter, they get to qualify for the next quarter. And it's very, very important to realize that most people don't realize how much they qualify, but when you qualify for 1 quarter, you're going to qualify for at least 2 quarters while we're trying to determine how much money you receive. If we can go to the next slide, the third way to qualify. So we've talked about shutdown and partial shutdown. We've talked about gross receipts. We're now going to talk about a brand new business. Most people don't realize this because they think, well, I just started, so do I qualify? If you started your business after February 15th of 2020, you can qualify for up to $50,000 per quarter in the 3rd and 4th quarter of 2021. So all they do is they look to make sure that you haven't averaged more than $1 million over the last 36 months. And as long as you didn't, you have a right to receive up to $100,000, even as a new business. And remember that start date, it's February 15th. So what does February 15th mean? If you incorporated after February 15th, you qualify. If you're a sole proprietor and you wouldn't have qualified, you still can qualify as long as we didn't put any money into our bank showing that we received money until after February 15th. If your business started before February 15th, the rest of our presentation is what applies. This is just for a business owner that's brand new, set up their business after February 15th. If we go to our next slide, what we'll talk about is in 2020, if you had under, so there's a lot of information on this page, but in 2020, it really breaks down to this. If you had under 100 employees in 2020 or under 500 employees in 2021, so if you could see what the government was doing in 2021, they were trying to make this way more easy for more businesses to get money so they can keep their people employed. Again, all related towards our politics and making sure recession didn't happen. And if you have over 100 employees or over 500 employees, you still qualify, but it's a little bit more difficult. You'll receive a little less per employee. But what I really want everyone to get so far out of this is every restaurant will qualify under some method. All right. And I think it would be a disservice to you if you didn't try. And if we go to our next slide, again, health insurance. Health insurance gets calculated into this. Personal time off gets calculated into this. Raises get calculated into this. So I don't want you to just think it's salary. I don't want anybody to think that for any reason at all to get you the most money you could possibly get, we want to let you know that we're going to check every single box to make sure that you can maximize what you receive. And if we go to our next slide, I just want to share something that changed. So in 2021, every owner of the company and their family members qualified. But late in November of 2021, our government came and we changed the rules. The rules changed because what happened was they realized in the first and second round of PPP and in that SBA loan, if any of you applied for it, what happened was the owners greatly benefited and they decided it really was more about the business that should be benefiting. And I know that sounds weird because mostly the benefit of a business is also the benefit of an owner. So they changed their actual outlook towards it. And what that did was it actually started to say, okay, if the owner receives more than 50%, he or she and their family do not qualify. They still get ERC, their wages just are not part of the calculation. But if you're a minority owner of the company, you own less than 50%, you would qualify. So we'll go to the next slide, and this is how we get to our $26,000. So in 2020, 50% of the first $10,000 of wages, we take 50% of that first $10,000 of wages, which would be $5,000, and that's how much money you'd receive for each employee you paid $10,000 or more. This credit started March 13th. So what does that mean? Let's take an example, and we'll just use this throughout. We have 2 employees only. One of them makes $20,000 a quarter, and one makes $2,000 a quarter. The employee that makes $20,000 a quarter, we only can get 50% of the first $10,000 or $5,000. So this is really where our government was really looking at how to help the employees who weren't making an abundance of money and who were really just making what they considered the bare minimum. So it's 50% of that first 10,000. If the employee made only 2,000, so for many of the restaurants here, you have part-time employees. If you made 2,000, you still get 50% of 2,000, or you get 1,000. I'm just letting you know anybody over 10 only gets 50% of the first 10. And if we go to our next slide, what you'll start to see is the government really saw a disaster coming. So they kicked up 2021 even more. Instead of 50% a quarter, you start to receive 70% of the first 10,000. So using our same example, we have 2 employees. You're getting $20,000 for one employee. You get 70% of the first 10,000 or 7,000 a quarter. And for that employee who made 2,000, the part-time employee, 70% of 2,000 is 1,400. And I have to keep repeating this part. This is for W-2 employees, so it doesn't count for contractors or people you're paying under the table. The government only knows how to keep track of who was paid as a W-2 employee. So if we go to our next slide, what we're going to see pretty much is if we look at our first quarter, if we look at 2020 and we see you can get up to 50% of the first 10,000, 50% of 10,000 is $5,000. If we go to 2021 and we can receive 70% of the first 10,000 for quarter 1, 2, and 3, we can earn 7,000 for the first quarter of 21, 7,000 for the second quarter of 21, 7,000 for the third quarter of 21. If we add up 5,000, 7,000, 7,000, and 7,000, we get to that magic number, 26,000. Here is where my firm gets very frustrated at other accounting firms when we look at this. You can't double dip for wages. What does that mean? What it means is many times when accounting firms or even individuals like yourselves, you applied for your PPP, what you did was you took the easy way out, and what they did was they put all of the forgiveness, which we're going to also need to look at, they put all the forgiveness to one thing, wages. What should have been done if they took the time, and it did take time, they should have looked at your insurance, your rent, your utilities, and put as much to rent, utilities, and insurance as possible. So for anybody who hadn't had their forgiveness, what we looked at doing was changing it, putting as much as we could to rent, utilities, and insurance, and that would even have given you a greater ERC benefit because the government does reduce it by any PPP you receive for labor. And if we go to our next slide, let's talk about, okay, so now we have 20 employees and the government's giving us $500,000, and that's amazing. Do we pay taxes on that $500,000? The answer is today, yes. I hope tomorrow, no. If we remember the PPP and the PPP forgiveness, originally PPP, when you received your money, was taxable. The government later, due to a lot of lobbying and a lot of complaining, received notice and they made the decision to make it non-taxable. Right now, the employee retention credit is taxable, And we are all praying together that they will come out and say it'll be non-taxable. But at the moment, it is. So how does it work? It works very simple. We amend your payroll tax returns to reduce your payroll expense. And when you reduce your payroll expense, that gives you more income. But as we reduce your payroll expenses, let's say by $26,000, that's the money you receive. But because we reduce the expenses, you end up paying tax on that. The greatest thing in the history of this world, and I told you we've had our practice for 35 years, I've never seen this. The IRS is not charging any penalties when you amend your return, and they are paying you interest. So let's take a restaurant who's going to receive $3 million. The government's going to go back to 19 all the way to 2021 and pay you interest on that money. So it's kind of nice to see. And in our next slide, just one more thing I want to share, and that is there is a limitation for filing this. It's so much better, and thanks to the CPA community, we lobbied very hard in Congress. What we did was we were able to get everybody a 3-year extension from the date the original 940 was filed, 941 was filed. Let's think about, what does that mean? That means if you filed the second quarter in 2020, you have 3 years from that period to get this filed, or, which is usually the case, 2 years from the time you paid the tax. This is probably the only time I'd ever say for clients that didn't pay their taxes on time, it actually was a benefit because they have a 2-year extension from that. So I do want to tell you here at Manning Silverman, what we do for anybody, we will provide absolutely at no charge an evaluation to how much money you would receive back. We would show you how you received it, what you received it, how we made it the maximum amount you could receive. And once we do that, we would then share with you what that refund is going to look like. We would then share with you what our fee would be. We're happy to help any of you with anything that you need. Also happy to answer all kinds of questions for you at the end. And in our next slide, I just want to say thank you.
Thank you so much, Joel. That was very helpful. I had no idea that restaurants have 100% success rate. So I don't know why you wouldn't apply for this if you haven't already, and get all the tax credits you can. That was super helpful. Thank you. Now let's turn it over to Chloe and Brett from Paycor. Take it away.
Awesome. Thank you so much. Yeah, Joel, I think we are in the same boat of, like, we're just trying to put more money back into Illinois restaurants and finding ways to keep for them to take their organization to the next level. So the first thing that we want to kind of dive into is really, like, how can you control costs and do more with less? You know, and one thing I wanted to make sure that we're sharing is that I'm excited to talk with Chloe, my partner, you know, at Paycor. She is the Illinois area expert. I'm thrilled to have her weigh in with some real life examples of restaurants that are facing a lot of the challenges that we're seeing. She's a super valuable resource. So make sure that you're leveraging her expertise. So here's really the essence of our discussion. In uncertain economic times, it is, as Joel mentioned, like, there's a lot of recession indicators out there. It makes sense that we want to cut costs. However, if you cut too deeply or trim the wrong budgets, your employee morale, your staff morale, your ability to operate can be impacted. So in this section, we're going to talk about a couple of examples of ways to reduce expenses and save time without negatively impacting your staff. So let's go to the first one here. All right, so work opportunity tax credits is a big one. I mean, that's another thing where it's money in your pocket. When you hire and retain new employees from certain groups of people who may need help finding jobs, think like veterans or disabilities, you can get tax credits up to $9,600 per hire. The tax credit equals 40% of the employee's qualified wages if the employee works at least 400 hours during their first year. And employees who work at least 120 hours get you a credit equal up to 25% of employees' qualified wages. Chloe, do you have any examples of restaurants that have used WOTC to kind of impact their bottom line?
Yeah, Brett, absolutely. And good morning to the Illinois Restaurant Association. I'm so happy to be here with you. Yeah, so I reached out to a local restaurant operator who's a client and just said, hey, we talked about work opportunity tax credits 5 years ago when we brought you on board. I'm just curious, 5 years later, how is that working out for you? Is it as promised? And so this gentleman actually sent me a report showing what he's getting back. And last month it was $20,000 alone. Now, certainly that's dependent upon how many folks you employ and what types of folks you employ. But what that says to me is if you're not taking advantage of work opportunity tax credits, do. If you are, be sure that your partner has the appropriate form electronically embedded into your onboarding process. That's the best way to capture all the data required for a partner like us to go back and find the necessary documentation, which could include proof that they served in the military, et cetera, to be able to file those tax credits on your behalf. So quite simply, if you're not taking advantage, you're leaving a lot of money on the table. And if you are, make sure it's the appropriate technology to maximize what you're getting back, because there is a very big difference as to how this information is obtained and collected, and then in return, delivered to you.
Yeah, and one big stat that we like to share is that Paycor customers in totality claimed $24 million in work opportunity tax credits in 2022. So that's something you'll definitely want to take advantage of.
Yeah,
Cool.
and I'll also just point out that this industry has some of the most success when it comes to work opportunity tax credits, similar to ERC. So again, worth looking into.
Cool. Absolutely. All right. Cool. All right. Next slide here is we wanted to talk about Paycor found that nearly 70% of HR teams waste time on tedious manual workflows. And so in the restaurant space, that may not even be an HR team. That might be, the owner operator or somebody else on the staff. So there's manual HR tasks that are happening. When your business is trying to do more with less, burdensome HR admin is the first inefficiency that you can prioritize, because even if you don't think about it, much of your business is actually run through HR. I mean, that's you're in the, even though you're in the restaurant or hospitality business, you really are in the people. You need to be able to have required compliance documentation so that you can pull at a moment's notice, be able to check reporting regularly to stay in front of any potential issues, because as we know, if you have a compliance concern and it's you're working with the government, it's never pleasant. So really, a solution is a unified HR platform that serves as a single source of truth for employee data. That means that you kind of stay out of the weeds. You can kind of get alerts when things happen, and you can automatically update employee information through the life cycle. So with that, Polly, are there restaurant examples in Illinois where HR admin has really kind of impacted a business, and kind of what were some of their solutions around it?
Yeah. So aside from getting more shelf space back by not storing all of this paper documentation, for example, sexual harassment, diversity training. Not only do restaurateurs and their employees have a special set of sexual harassment compliance that each employee must go through once a year, also their managers have to go through a more extended version of that. Anti-trafficking is also one that the state is mandating. And so when you think about, from a compliance perspective, being able to easily resort back and view that, or to be able to send a report if audited, that all of your employees have taken the appropriate courses. It's also particularly helpful if there were to be an unemployment or claim from the DOL. Because while a piece of paper is great, it may contain a signature with a date. Those things are easily disputed if something goes to court. So you really need to have an electronic trail that stamps an electronic signature, date and time, as well as an IP address, because those are irrefutable. So not only is it going to protect you from a compliance perspective, get rid of all that paper that you've been storing, but it's also going to reduce time that owner operators, HR, payroll folks are answering questions for employees, because they also have a place to go. Or if there are questions that come your way, it's very, very quick and easy to answer them. So really giving you more time back to do the things that you want to do, which is, take care of your patrons and grow the business.
Exactly right. And the final point I'll put on this one too is just having that HR platform that integrates with that point of sale system or their third party apps. it has that, it gives you the benefits of unification, with the flexibility to kind of use the right partners. Cool. All right, next section we want to talk about here is to motivate employees and inspire the kind of loyalty that lasts. You really need to invest in 3 areas. One is leadership training. And the next is employee learning, and 3 is career development. Also add in meaningful benefits that address a full picture of well-being. The 3 areas, leadership is really that most important one. Leaders aren't born, they're trained. And an effective leader can really make a difference at your restaurant. Think about the folks that are, at your different locations and how they're making a difference. How are ways that you can, whether it's monetarily or through time or through training, how can you invest in them? All right, so let's talk about how, that first example here is of our, we actually did a recent survey. Can we go to the next slide? We did a recent survey on some of 6,000 professionals, and we found that 53% of organizations don't feel confident they could replace their managers with internal candidates within a month. Think about that. That's a problem. Managers account for 70% of the variance in employee engagement, but only 1 in 10 people have a naturally high capacity to manage. So if you don't have an internal pipeline of leadership talent, it can be difficult to quickly train people to step up into leadership roles. It's always, to address this outage, consider investing in your current managers, but also in succession planning to identify the next generation of leaders at your company. It's always best to be prepared in case a manager leaves. I mean, just think about, those leaders that are leading staff, that are leading shifts. Like if there are there those indispensable folks that if they left, would it really put you in a bind? So, Chloe, do you have any? I would love to get your perspective on an example of a company that's kind of really thinking about how to kind of empower their leaders and thinking about that next, that next line of leaders.
Yeah, so when you think about the next line of leaders, again, I can think of a client who lost basically a director, right? So director in HR, but also handled a lot of the payroll things and really knew how to use their payroll system. What they found is that they essentially, to use their term, had to promote by firing. So they did not have someone as a backup when this individual left who really understood the people on the ground, that understood how their systems work, what the point of sale integration looked like, and it really, really put them in a difficult place. So if you're able to take a look at the people that you have holistically across the organization, who wants to be promoted, who's excited about this industry, it really does protect you. And when you think about recession-proofing your business, the last thing that you want to do is lose someone who really promotes the ability for the organization to operate as a whole. Secondly, empowering managers, they are much, much happier when they can do things on the go. They're not sitting behind a desk all day. They're front of house, they're back of house. There's a lot that goes on into their job. And so if you can give them the power to do something from a mobile app, like approve time off or approve time to be paid in payroll, etc., it's going to make everyone's life much, much easier. And just their day-to-day level of satisfaction will be greater.
Yeah, absolutely. I think we think of succession planning. That's not just a CEO thing, right? So you got to think about those different leaders throughout your organization, and just finding ways to prioritize, drive that engagement and helping improve the experience for those leaders too, because it has a downstream effect for the rest of your restaurant. All right. Next thing here I wanted to talk about is training your employees to learn new skills and become more valuable in the workforce makes a whole lot of sense. For one, it's a powerful driver of retention. 91% of employees say that career development and training are important factors when deciding whether to stay, whether to take a new job or stay with their current provider. And Gallup found that 87% of millennials, the generation that actually makes up half this workforce, they say that professional development is the most important factor when evaluating a job offer. And secondly, as the pool of available talent shrinks, so you talk about, recession concerns and unemployment, we're still in a historically tight labor market. So it's important to train and develop employees. It's a lot easier to do that than to try to hire and recruit others. So Chloe, would love your perspective on some examples of restaurants, really finding ways to train and upskill their kind of current staff.
Yeah, so the first thing that I would add to that, Brett, is that that's not just for salaried employees. This is for hourly employees. When you think about how competitive the market, there are folks who will leave for 25 cents, 50 cents more an hour because they see greater opportunity. So don't think about this, giving people tools to learn how to be better at Excel or accounting. This is really applicable to all employees. I have clients that use this not only to maintain the ongoing sexual harassment, diversity, and trafficking courses that are necessary to be taken yearly, but they're also, providing them things like as simple as the best way to greet someone in front of house, or I do want to become a manager. So how do I learn to lead as, someone who's an hourly person today? I mean, really the options are limitless, and they can be very, very, very specific to, your, not just your industry, but just how you operate your business. And so again, knowing, and I think Gen Z is even a bigger advocate of this, they want tools. They will stay with you if they see that there's a trajectory for them to hone in what's important to them, but also that you are invested in them, which also betters the culture.
Great. Yeah, great perspective. Yeah, great story there. It's a beyond just a managerial and a salaried staff thing. All right. Another thing when you think about how to make your place a great restaurant, a great place to work, is you got to think about how you're adding value to your employees, and think about especially in the past 2 years, kind of what's changed in that employee mindset. 72% of Americans are stressed about finances, right? And we got adults that are struggling to pay off debt. We found that they are 3 times more likely to suffer from a mental health disorder, and twice as likely to report overall health. More than 50% have gone into debt over the past 5 years due to medical or dental bills, and stress at home carries into the workplace. So nearly 30% of employees say that financial stress has affected their capacity to focus. And it says, and a lot of them have said that it's reduced their on-the-job satisfaction. So stress at home, stress, with bills has really, has an impact with the workers at your restaurant. So, Chloe, think of an example from different restaurants you've worked with about how they're finding ways to use health benefits and thinking about mental health to really, make their, help improve their employee experience.
Yeah, so a couple things, Brett. The first one is, really leverage your employee benefits broker. There are a ton of different programs out there that are no cost for employees to adopt. Just from a mental perspective, right? Remember, maybe it's Talkspace, maybe it's something else. But even beyond that, there are things that you can do to help employees feel more financially secure, which in turn is going to make them less stressed at home and, maybe have a better outlook on the day when they're at work. And that is on-demand pay, or earned wage access. This should be hands-free to the payroll administrator, owner-operator who's going through this. It should not cost you anything to provide this to your employees. Employees should be able to, through an app, see based on the time that they've worked, what they can go ahead and take from their paycheck as a result of those wages earned. And I have a few interesting stats that came from Visa, actually. The first one is that 95% of workers said that they want to work at a company that provides this. They want to be able to access the money once they've earned their money. They don't want to wait weekly, bi-weekly, certainly not semi-monthly or monthly. 89% of workers said that they are more likely to stay with an employer that provides them on-demand pay, earned wage access. And lastly, 79% of those polled by Visa said that they would leave for someone who does provide it. They don't need an increase in pay. They don't need more benefits. They want their money. So again, thinking about different ways to invest in your employees by making their lives easier on a day-to-day basis that does not cost you or them anything is really, really critical right now, particularly when we think about where the economy may continue to go.
Yeah, I think that's an excellent point. The point that we want to hammer home is there are resources that you already have or can have access to that are really no or low cost to you. And those are ways that you can make a big impact to your team without without really breaking the bank for you. So just a couple of bullets on that I wanted to kind of make sure I hammered home. So the on-demand pay, Chloe's absolutely right. That's a great way to relieve that financial stress, and it can be a differentiator for you. There are there's services to employers that you can give employees like an interest-free payment plan for health providers. Work with that benefits broker. Those are things that you can really that can really add a lot of value to your employees. Okay, cool. All right. So the next thing I wanted to talk about here was the mental health at work. So in the restaurant space, that is just as relevant as it is in the broader market. Paycor, we actually did some research and found that 86% of business leaders are concerned about mental health in the workplace. And in the restaurant industry, it could be leading that charge. 1 in 5 American adults will have a diagnosable mental health condition in any given year. That's just a CDC stat. And 67% of U.S. workers say they're burned out. And we have 50% of Black and Latino workers have left a job partially due to mental health concerns, and about 48% of Gen Z feel they feel stressed or anxious all the time. So there is just a mental health challenge. There's things to consider when how you can address mental health at work. So Chloe, do you have any examples of how some restaurant leaders have addressed mental health at work for their team?
Yeah, I mean, I think it's pretty evident because, well, the first thing I should preface this with is that I've attended many of the IRA meetings, and I know how invested everyone on this call is in their people. Everyone is family, right? And so it can be pretty evident when someone is having struggle, whether that comes through just conversations they have with you directly or how they, interact with people that are visiting, your institutions, your restaurants. And so a couple of things is just to ask open-ended questions, check in with your people. Think about small things like, hey, we're gonna spend an hour today not talking about what's on the menu or this, that, and the other, or hey, this person was short, but let's just do something that's really, kind of referencing back to what our culture is. What's important to us? How are you guys feeling? Is what our message is to the community the same as to how you're feeling here? I mean, that doesn't cost anyone anything, but it's always important just to ask. Again, referencing back to, your benefits broker, like a hub or someone like that, they have so many tools that they can provide you and the employee that don't cost anything. So maybe there's someone who doesn't feel comfortable about speaking up, but they're just not doing very well. Think outside of the box. And again, while it's something that may not be top of mind for you, it certainly is for the people that are staffing your employment. May seem a little bit basic and to the point, but again, I think that, the more and more I'm talking to people that are hiring hourly workers, young people that are excited about this industry, but they're just having a tough time, they're really able to kind of diagnose what that is and then lean on their existing partners, or just, to my previous point, just having that conversation and doing team building and engaging things that make people feel a little bit stressed when they're at the workplace.
That's a great point. Really, the 3 takeaways for that, for about ways to summarize the kind of mental health, addressing mental health at work is first, ask leaders to model healthy behavior. They take their time off. If they take their time off, their direct reports will too. When leaders admit mistakes or simply feel they can feel comfortable saying, I don't know, let me get back with you. That gets everyone okay with being showing some vulnerability. Second, building an inclusive workplace, as vulnerable populations will kind of suffer in silence. So just make sure that we're building an environment where people can share. And third, like Chloe said, talk to that trusted healthcare benefits broker, understand well-being programs that you can offer. Okay, cool. Next thing we're going to talk about here is just developing some listening tools so you can really foster that engagement with your team. we found that, really company culture is really the number one driver of retention. So, we've asked, we asked some open-ended questions and kind of got some thoughts on, what is what's the driver of culture? And it turns out that it's trust. Trust is really that, employees know that their employer has their best interest at heart. Workers want to trust that their leaders are acting in their best interests, not just in the best interest of the business. And we've also found that communication is a driver of trust. Companies that give employees channels to express their feelings anonymously and that valued candid conversations between managers and employees fared better than ones that didn't have that. So, Chloe, are there certain examples that you found that that restaurants had ways of building that communication and that trust between their employees and the leadership?
Yeah, so I think historically, at least for my 9 years with Paycor and being passionate about the hospitality industry, is that you are asked to do so much more with less, right? Margins can be very lean. So it can be a tough proposal to say, but you should spend an extra 50 cents per employee per month in this tool, and let me tell you why. So early on, it was a little bit of a different proposal. Or a little bit of a difficult proposal, but I went back in the spirit of this webinar to ask some of my clients, have you seen an impact? What does that look like? And I was shocked at their response. Absolutely worth having a tool that allows your employees to express their sentiment on either just culture as a whole. What does the pay look like? Well, we'd like to see Illinois Secure Choice being offered to us, etc. And it has increased retention. I did an average based on their average by about 30%. So think about that number. It's staggering. People feel heard. It provides very easy data for leaders to make changes and then to roll that out. So yeah, to Brett's point, it doesn't have to be electronic. It could be, a box that someone's dropping in comment cards. But being able to listen to your employees is, critically important, and it makes them want to, be advocates for you in the organization, tell their friends to come work there because they're pleased with what their, owners, operators, frontline managers are doing for them.
Great. Awesome. All right. So what I wanted to wrap up with is just kind of summarizing what we talked about. And thank you guys for engaging with us. Great engagement in the chat here too. So really the takeaways are, one, take advantage of work opportunity tax credits. That's money on the table that you guys can be earning. Two, save time with HR automation and kind of get access to the compliance documentations and make that electronic. Three, empower your frontline managers. That's really the lifeblood of your organization. Four, you want to always help your employees learn new skills and find ways to invest in them. 5, provide access to healthcare payment plans and those kind of auxiliary benefits that add value to your employees without really damaging the impact to your bottom line too severely. Prioritize mental health at work, and then invest in new ways to listen to your team so you're showing that engagement. We actually have dozens of articles, guides, infographics, webinars on these different HR topics that we provide monthly. So make sure to check those out as you go through. We just wanted to thank you guys for the chance to share. We really value our relationship with the Illinois Restaurant Association, and we're excited about how we can add value to the groups here. So that's our portion of the presentation, and just thank you so much for the engagement.
Thank you so much, Brett and Chloe and Joel. This was great. Sorry about the technical difficulties on the slides there at the end, but really appreciate all the information and knowing that, like Joel said, there's not any restaurant that's been turned down from ERC, and the mental health piece I think is really important, especially the stats about how employees want to get their cash right away, which I think is a benefit in a lot of the hospitality industries. If you're a tipped employee, you get that cash right away. But I was not aware of the stakes and the stats there. So thank you. Next, we're going to go to some questions here. And the first question I'm going to send to Joel because it's about ERC tax credits. So what if someone asked, what if I'm the only full-time employee? Do they still qualify for ERC credits?
So if they're the owner of the company and they own a majority of the company, then the answer would be no. If they are a minority owner, the answer would be yes. And I did also just want to add, first I wanted to say great ideas by Paycor. I think it should make all of you think a lot. It's making me think a lot, hopefully to be a better owner myself. But also just remember on this ERC that you could receive tens of thousands, hundreds of thousands, even millions of dollars. You could do anything you wish with this money. So you can invest it, you could save it, or you could spend it. Buy something for yourself that you wish, or your loved ones, or even bonuses for your staff. So again, I just want to remind you, even on each individual question, each individual case, if you send me a question or something, we're happy. There's no charge to give you a very detailed answer to your question.
Thanks so much. Yeah, and I just want to remind everyone, we're going to try to get to all the questions here, but all the contact information will be sent over and all these slides and this recording afterwards. Follow-up question for ERC is someone asked that they've been told it's too late to apply by their accountant. Is that, you briefly covered it, I believe, but is that accurate, Joel?
Inaccurate completely. You have plenty of time to file for the employee retention credit. Again, the deadline is 2 years after you paid your last tax for 2020, which would give you till, if you think about it, and 3 years after filing the tax return. So if you're looking at somebody who filed something in July of 2020 or July of 2021, you'll have till July of 23 or July of 24. So the real deadline date is really July of 2024 at the outset.
And then Brett or Chloe, do you have anything to add about tax credits, like the WOTC tax credit? Is there a deadline there or anything else that you guys have encountered?
No, that's the beauty of it. It's ongoing investment in, employing those who've maybe had a more challenging time in the past. It could be people that support low income. They've been previously unemployed for a while, veterans, people who have maybe served time. So people that are assets and really want to work very, very hard for someone who's willing to give them a chance. And the government rewards you for that. I will say, Joel is spot on though. Again, all restaurants will qualify for ERC. I have seen numbers be between $100,000 up to $6 million. So don't make any assumptions. Don't listen to that CPA that said it's too late. Talk to Joel. Money on the table.
That's great. Thank you. Yeah. So other follow-up question with the division of ERC and family members who own a business. So theoretically, if two family members own a business, one is 51%, one is 49%, because you mentioned shareholders, do they both not qualify for ERC?
So we're going to get into a real specific thing here. So if one is 51 and one's 49, they're the exact same family, meaning I'm assuming husband, wife, brothers, sisters. The answer then would be, if they're the only employees, no. But what I'd really like to do is take it off air and we can see how we could find a way to see if there's any way for them to benefit by the refund.
Great, thank you. And just to clarify here, I know we're talking about restaurants and the hospitality industry here, but for ERC, do you have to be a restaurant or does any small business?
So it's any business owner in America or any of our Puerto Rico and our Virgin Islands. So everybody is entitled to receive the employee retention credit regardless of business. It could be for-profit, it could be non-for-profit. So the specialty is there is no reason everybody shouldn't try to apply. The worst that can happen is either A, we would tell them they didn't qualify, or B, the government would say they didn't qualify. But I will tell you, so far we've submitted on over 4,000 of these applications. We're not having one issue with any. The government has a really nice system now. They've gotten better and better. It's taking around 3 to 4 months to get the refund. It goes through a process where they're looking at your payroll records. And once they see the payroll records, there's no reason to have any issues whatsoever once they say, yes, here's your money.
And what's the general turnaround time to receive ERC funds after you apply?
Right now, it's running. It's running. I'm going to have to say 3 to 6 months, but it's been running between 3 and 4 months from the time it's submitted. The money comes pretty quickly. Some of you will receive your money a little oddly. So people start to say, well, Joel, did you make a mistake? The answer is no. Sometimes when you file your 5 quarters of refund, the government sends one check at a time. Sometimes they send 2020 together, then 2021 separate. And then they throw in this little thing called interest on the money. So for people, much like Chloe said, we've had it anywhere. I think the lowest we've gotten anybody was 19,000. The highest we got somebody was 6.5 million. Most of the people that are on this are younger than I am, but I want to tell you, if I had my dream, there used to be this guy, his name was Ed McMahon, and he used to come to people's houses from Publisher Clearinghouse with these massive checks. I wish that was me, but unfortunately the IRS just mails it directly to you.
The actual size checks, as opposed to the novelty checks, are probably easier to catch, though.
Yes.
Now, speaking of tax credits, are there any other tax credits that are applicable for, say, continuing education for employees or managers?
If you're directing to me?
Yeah, Joel, you can start, and then we'll throw it to Brett or Chloe if you have anything to add.
So there's lots of things that restaurant owners don't really even think about. Some things that I think Chloe and Brett might want to talk about, which are like R&D credits. It's going to sound really weird that a restaurant could actually have an R&D credit, but sometimes they invest into their business. They come up with certain ideas. We have a restaurant owner who created a really neat lighting show in their restaurant, and then they invested all the, they paid for all of it. And one of the things that Chloe and Brett could probably explain better is if you keep your time, this is so important when it comes to R&D. This is so important to any credit. Documenting the time you spend, showing, let's say an employee, for example, 35% of their time is spent on something, 65% spent on something else. If we can keep track of that time, those credits can apply. One of the things I strongly would offer anybody, we're happy to give free tax strategies to anybody also that's a member of the Illinois Restaurant Association, because one of the greatest things that you can find for college education credits are sometimes a husband and a wife earn $150,000 or more. So when they complete their FAFSA, which is the application to try to get money from the government for school, they just get turned down. It's just a flat out turn down. But some of the neat things you can do is you can hire your children. You could pay them $12,540, more need for payroll, but you could pay them $12,540 and they pay no federal tax on it. If you have a kid in college, what I strongly recommend is, if you're going to help them, let's just pretend an individual is going to college for $50,000 and you're the parents and you want to give your child $30,000. As a business owner, think about paying that child the $30,000 and letting them pay their own college. Two things happen. If I was making $160,000 with my wife, and now I give my kid 30, so now I'm only making $130,000. I'm under that magic number of $150,000 for college education, and I probably will get some money from universities to send my kid there. And then my child, because they're under the 150, they're only making 30,000 from my business. That child will end up getting the education and lifetime college credits. So a child earning 30,000, the first 12,540, and I shouldn't say child because they're 18, but the first $12,540 that they would earn, they pay zero tax. And then on the next 17,460, they pay such little tax. And when we add these college credits, they'd end up paying no tax. No federal tax. I do want to say one thing before I will get cut off, I'm sure. A huge thank you to all of you here at the Illinois Restaurant Association, to Karen and to Teresa, who put on a wonderful show today. And I'd be remiss if I didn't say thank you to Paula, who's my assistant, who behind the scenes makes everything happen. She just tells me where to go and where to show up, and I do. And then a special thanks to Brett and Chloe, who I got to at least meet here on the last couple of days of working together. A huge thank you, because I think every restaurant owner, you need Karen, you need Teresa to share these amazing ideas, whether it's myself, Chloe, or Brett, or other people. Listen and really listen, because I got to tell you, every time I listen, I take some great things away from the seminars.
Yeah, I agree. We're about out of time. And I want to thank everyone here, Joel, Brett, Chloe, from Paycor and Manning Silverman and Company. I want to remind everyone that this will be sent to you along with the contact information for everyone for any questions we did not get to today. I want to thank all of our panelists, as well as the Cook County Small Business Source, and the contact information will be sent over, and they also offer services. Each company offers services in multiple languages. So thank you, everyone. This has been great and very educational, and I appreciate everyone's time. Have a good Thursday.
Thanks,
Thank
guys.
you all.
Thank you.
Thank you.